So we've all heard buy term, invest the difference versus whole life insurance. What is the best thing to do? We have a real life scenario here where we had a situation for a male, he's 49, and he needed $2 million of insurance. And so the cost of term insurance for him is quite substantial. And so what we wanted to do is, instead of just buying term insurance, putting it in place, we always want to look at the full financial situation of a client. What is best in all areas of their wealth, in their tax savings? How can we actually implement insurance and create the most wealth that we can? So in this situation, the male is 49, needs the $2 million. And for $2 million of insurance, the monthly premium was $230 per month. And so who wants to pay for insurance? Nobody wants to pay for these expensive monthly payments for 10 years, cancel it, and not get anything back. Sometimes that is the best thing to do if we're looking at your whole situation. So what we want to do is really compare buy term, invest the difference versus buying permanent insurance. And so the thing about this situation, and what we see very often, is that husband and wife both work at the company. So if he was to pass away, there really is no business anymore. She is not going to take the company over. She's not going to run it. The other thing is that these people haven't achieved their retirement goals yet, and they won't achieve them after 10 years. So even though 10-year term is the best way, cheapest way to do it, after 10 years, they still need insurance. So after the 10 years, the insurance costs are going to jump up to $846 per month. We don't feel that that's going to be achievable or affordable at that time in 10 years. So what we wanted to do is forward think, because we've got a few more assets today, is there a way to actually buy permanent insurance and come out in the end with more wealth than if you were just to buy term? We didn't want to risk in 10 years the client being uninsurable as well. So if we could predict that he was insurable in 10 years, it would be a good strategy is to buy 10-year term, cancel it, buy another 10-year term for the second term. But we don't know that. And so what we need to do in any person's situation is really figure out what the number one main goal is. So if your main goal is to build wealth, we're going to come to one conclusion in this case scenario. If your main goal is to make sure you have insurance protection in place, then we're going to come to a different conclusion in this case study. So let's get into the numbers. You can see on the chart here that if we buy 10-year term insurance and the death benefit's $2 million, the annual premium, the monthly premium analyzed, is $2,769. And so if we accumulate this over the 10 years, this person's going to pay $27,691 in insurance premium and have the $2 million. After the 10 years, you're going to see it heap up to $10,154 per year for the $2 million. So what we want to do is we want to consider permanent insurance. And what we did is we first started to look at what whole life insurance would look like for them. Because with whole life, we have the opportunity to pay for insurance costs, cancel the policy, and get back 100% of the premiums you paid for. So that sounds pretty good, doesn't it? Who wouldn't want to do that? Well, a couple things. You have to be able to afford the cash flow of the heaped premium for whole life insurance. Also, the number one thing that comes to my mind is what's the opportunity cost if I do that? So in this scenario, what we've done is we've purposely said we want to spend the same amount as what term insurance would cost, plus put in an extra $5,000 per year into the whole life. And so what we want to do is compare whole life to investing $5,000 elsewhere. What would that provide? And the reason why we came up with the extra $5,000 is we looked at the client's total situation, and we identified that this person was paying $10,000 in accounting fees. And their accounting fees had just escalated a little bit every year as the company was making more money, so his costs went up. And he commented to me he doesn't feel like he's getting any more value, but he's paying more, and really didn't understand why his bill's going up. So we can save them on the annual filing fees. I know for sure we can file for at least $5,000 less than what they're paying. I know more, but we just started with $5,000. So we're gonna take the $5,000 from the accounting fees that we're saving them and plug it into the whole life policy. Now, not everyone has this, situation where they can free up money here and there. But what we would do is every situation's different, and we might want to pull money from different savings or different areas and look at a solution such as this. But for this situation, we wanted to save them on the accounting fees and provide them with more value with this situation. So if you look out, the cumulative premium that this policy would cost is $78,870 per year. It's the highlighted number there. That's a heck of a lot more than paying for term insurance. So why would this possibly be better? You can see there's a cash value column. And so if this person was to cancel after the 10 years, they would get back $46,647. Now, that's still costing you just as much as the term insurance, so you'd be better off buying term, investing the difference. But this is where this situation's a bit unique. Because this person needs insurance longer than the 10 years, we can stop paying these premiums after 10 years and still have some death benefit. Now, you'll see it drop quite significantly. It goes down to $187,000, but that's still providing $187,000, and you'll see it continue to go to year 19, and it goes to age 100 if you wish. I stopped it after year 19. But this provides them with that extra money that they need for their retirement shortfall until they hit their retirement goals. And remember, that was one of the key, most important items for this person. Now, let's look into the opportunity cost. Maybe you are better just investing that extra $5,000. Would you have just as much cash value and death benefit in a way that it would beat the whole life policy? Now, the key thing here is that where would you invest the extra $5,000? In this scenario, we've looked at a TFSA versus a non-registered account, so something outside of a TFSA. Huge difference in outcome and conclusion. So in the chart below here, you'll see $5,000 invested, and I'm only doing it for 10 years to make an apples to apples comparison, going at 6% rate of return. You will see in the highlighted graph there, what we want to do is we want to look all the way down to year 18 to make it comparable to the whole life policy. So in year 18, you'll see the highlighted number of $111,343. So if this person's main goal was wealth growth and wealth accumulation, this person would walk away with $111,000 if they invested in TFSA versus the $79,000 if they invested it into the whole life policy. So I would tell them buy term, invest the difference. However, if this person doesn't have TFSA room and we have to look outside of a TFSA, here's where it looks. The cash value or the growth of the account after the 18th year is $87,000. Now, in my opinion, if I was to have $87,000 of cash or $79,000 with the whole life policy, but all this extra death benefit, which is one of my most main goals, I would pick the whole life policy over investing into a non-registered account. That would provide more balanced and just more areas of coverage. So the big conclusion here is that if you're just looking to buy insurance and you're just looking at one concept of buy term, invest the difference, or I just want to buy whole life, you can't conclude what is best for you until you look at the whole situation. You got to look at what your options are and what your opportunity cost is. We always look at every area, because if we just look at one of them, we can't instantly tell you what's best. We have to look at the whole situation and more so all of the opportunity costs. So in conclusion, for someone who's after wealth accumulation, usually buying term, investing the difference is going to be the best. Someone who is after long-term insurance protection that they need, are not hitting retirement goals, and who might not necessarily be able to afford, permanent insurance forever, buying a whole life policy and paying premiums and then canceling later to use the cash for retirement is probably the best way to go, especially if they only have non-registered accounts. So I hope that you've understood the main conclusion of this is that you have to look at all the areas. You have to look at the opportunity cost to determine what scenario is best for you, but every situation is going to be a bit different, and every conclusion will be a bit different based on what your overall goals are.